Venture Capital 101. We'll give sort of an overview of how venture capital works. Some may know it well, some may not know it so well. If nothing else, it's a review. So this is about how to finance your company. Commonly, if you have a new company, we call it NewCo. So that's kind of the expression that people use. There are really two ways to finance your company. One is with debt from a bank, and one is with venture capital. So just real quickly, I'll talk about the differences between those two. So you use the financing to fund the equipment that you need to buy. You might need to buy materials, maybe some for what you're manufacturing. If it's a chemical, you may have chemicals that you need to purchase for manufacturing. By far, the biggest expense is employees. So you're going to have to pay employees. I would say that yourself, if you're sort of an academic and you're looking to do this on the side, at some point you should talk about paying yourself. Otherwise, the investors sort of question, is this like a hobby side thing for you, or are you serious about this? So two dominant sources of financing for your company are equity, which is stock. So people buy a piece of your company, or debt. So you're borrowing against assets with debt. So the unfortunate reality, if you have a startup, is a bank's not going to lend you money unless you give some collateral, and they're going to ask for your home or your car as collateral. So think hard about that. So debt, as you know, debt holders, banks, are not owners of your company. If your company does fail, they're going to get paid first. They're not in this for risk. They just want to get interest on the money they're lending you. And if it's high risk, they're going to charge you a higher interest rate. So if your company is very successful, the amount of money they can make is very limited. They can only get their principal and interest. So that's debt from banks. So the value that they can capture plateaus at the principal and interest. In terms of a bigger return on investment, that's for venture capitalists and investors. There's no limit to how much money they can capture from what they put into you. So the risk reward is much higher for venture capital, which is why they get paid second after the banks. So if your business goes under, and more than half of all venture funded business go under. So don't let that depress you. Yes. It's the journey, right? So equity is ownership. Usually there's multiple owners for the company. The founders are probably owners. You've decided how to split up the company. And then people that invest in it, oftentimes the initial investors are friends and family. And then you're probably going to create, if you form a C Corp board of directors, if you have an LLC, you can have something that's similar to a board of directors with the members. So, but again, the equity holders do not get their money back until those that loaned you money get paid back first. So, because the banks didn't go on this for risk. So, but they can have unlimited sharing in your success. So these are the sources of equity financing. Could be friends and family. Again, be very careful about having relatives invest in your company. You have to make sure they understand they could lose it all. That could make holidays very awkward. Angel investors is highly variable, but generally less than $1 million or so is what you're going to get from angels. A couple 100,000 is pretty common. Venture capital, bigger numbers. In Wisconsin, the numbers tend to be a little bit smaller. But nationally, I forget the average. I think is probably more than 10 million for a Series A. So, so you start out with friends and family, then you go to angels, then you go to venture capital. So just be careful if you're planning to raise venture capital to not get too many people that are owning your company, the cap table. Investors don't like it if there's too many owners of your company. Or just if you do have that, make sure you kind of manage it so the company is not out of control with too many people. So how do you value your company? You're going to have to do this at some point when you're talking to investors. The investors you talk to might even ask you, what's your company worth? What's the pre-money valuation? So you have to do that. There's multiple methods that you can use to value your company. The most common one is comparables. So I sort of joke that my kids, when they were teenagers, probably had no idea how much a house costs. I could tell them it was $20,000 or $2 million, they probably wouldn't know. And then you're not used to how much biotech companies or other companies sell for either. So you have to go out and look for comparables and see what other ones sold for. So when you're going to tell an investor what the exit value is, you should base it on comparables. So, and make sure you're realistic about comparables, that what you're comparing to really is comparable to what you have. So the other thing, if you're lucky enough to have done an IPO, it's easy to look at the stock price. So just look at all of the shares that are outstanding and multiply that by the stock price. That's the market capitalization. That's the value of your company. So, and if you're a finance whiz and you actually have a lot of revenue, you can look at cash flow and you can calculate what the company is worth from cash flow. That only applies for those of you that are in a business where by the time you sell, you're going to have a lot of sales. And that's maybe not a lot of businesses, but for some of you, it could be. About 4 or 5 of you have software health tech applications. It's very possible that by the time you're looking to exit, you will have enough revenue where you can value your company that way. There is a term, Ebitda, which is basically a fancy word for profit, where you've ignored things like tax and interest and depreciation and amortization, which really has nothing to do with how successful your business is. So you can think of it as a multiple of profit or revenue is one way to value your company. And I talked to some of you before, so you may have seen this before, but so here's some multiples of Ebitda. So the Coca-Cola, if you look at the market capitalization divided by what Ebitda is, they're valued at 14 times that. This is kind of like the price earnings ratio. So if you want to see what a company is worth, usually there's some agreed upon standard for what a multiple of revenue or profit / Ebitda is reasonable. So here are some numbers. If you guys want, I can share the slides, but for example, you see medical devices are valued at about 14 to 18 times Ebitda. So if you're projecting revenue, you know, basically you can project that in profit and Ebitda, then you can tell somebody at this point in time will be worth 15 times that. So just be careful about being too bold about what you project. It kind of rubs investors the wrong way. They want to know that you're grounded in reality. So I think, you know, you don't have to get, when you're predicting into the future, you know, you could just either project revenue or profit, which you'll call it Ebitda, but you know, you're not actually going to calculate Ebitda. You're just going to calculate your profit. So, and profit is probably close enough to Ebitda where it's a good approximation. So, you know, revenue versus profit, I don't know, it depends what your profit margin is. It's probably different by a factor of 2. So if you're trading at 14 times Ebitda, maybe you would be worth 7 times revenue. So if your profit margins are 50%. So it's hard enough to predict what revenue is going to be. So, yeah. So the only way for investors to cash out, by the way, is I mentioned earlier, a liquidity event. So you cannot just sell your shares. You might, you know, like your cousin Bob quite a bit and you like to sell him your shares. Be careful about that. There are these things called securities laws. These are not publicly traded stocks. These are privately held. So you should talk to a lawyer before you start selling stocks. So you can do a private offering, and there are ways to transfer stocks, but these are not publicly traded stocks. There's really no way for you to cash out until somebody purchases the company and gives you money for your shares, or you do an IPO. So sales are not something you can do. Now, if you're trying to raise money and you're presenting to, you know, investors, venture capitalists, or even angel groups, there are regulations in securities law that let you do this. And I don't want to get into the minutia of securities law, but Reg D is not minutia. That's how people do private offerings. It's called Regulation D Exemption, and Rule 506 is one of those. So it's 506B, 506C, and 504. You would basically talk to a lawyer that would help you figure out, okay, I'm pitching to a group of angels. They're going to give me $200,000 in exchange for stock. This is a Reg D offering, and you're going to have the securities lawyer sort of run through the paperwork to make this happen. It doesn't have to be that expensive, as opposed to a public offering, which is probably going to be like $1 million or so. Reg D is a way to get out of having to do the disclosures associated with a public offering. If the Securities and Exchange Commission says, you just did a public offering, you are in deep trouble. Because what they're saying is you should have spent $1 million to do all the disclosures that are needed for an IPO, and you didn't. So you want to get an exemption so you don't have to do all of that expensive disclosure stuff, and Reg D is how you do that. So there have been more Reg D fundings in the US, 1.8 trillion, than there are IPOs. So these kind of private placements are actually more prevalent in terms of dollar amount than IPOs. So even though some of you probably haven't heard about Reg D. So it's about 1.8 trillion versus 1.5 trillion in 2017 for financing companies. This was my experience, and I was just a scientist fresh out of my postdoc, but taking along with some people that knew what they were doing. So we did two rounds, and these were basically Reg D private placements in California. And I kind of point this out because in California, these numbers are not that unusual. In Wisconsin, these numbers are quite unusual. So it's hard to find venture capital firms that can do Series A financings of say $5 to $10 million in Wisconsin. They're here. I mean, certainly, you know, if you're in the sort of the healthcare space, venture investors can, but beyond venture investors, there's not a whole lot, maybe others, I don't know, 4490 or something. So, yeah. So just, you know, if some of you, if you're raising money and you're getting frustrated because nobody's listening to you, just realize you might be fishing in the wrong pond. Don't be asking people for money when they're never going to give it to you because they fund in the $1 to $2 million range and you need 5 to 10. So you should try to understand what they fund at. So when you raise money, and as a founder, you're going to have what's called common stock. It's kind of the baseline of ownership in a company, a corporation. If you have, you know, 200,000 of 1 million shares, you have 20% in the company. You have right to 20% of the profits if there's dividends. There's another kind of stock called preferred stock, and that would be what the investors get. So it has certain benefits over the common stock. And one of the most important benefits of the preferred stock is that they get paid before the common stock goes. So just like the banks get paid first, the next in line to get paid are the investors. Because they're thinking, you're the entrepreneur, you were the one taking the risk, not me. So if this thing goes south, I want to get paid before you get paid. So you can think that that's unfair, but you got to remember the golden rule. Just the people with the gold make the rules. This I got from Tim Keene, who's leads the Golden Angels. So that's just the way it is. They're going to get preferred stock, you're going to get common. So that's kind of the pecking order. So now stocks can have different voting privileges associated with them. Usually the typical is that it's proportional to the number of shares that you have. For some reason, in some cases, you may not want somebody to have voting privileges, even though they're investing, and that could be negotiated with the preferred stocks that they have. A lot of this, how you handle voting and all of that is handled by what's called the operating agreement if you have an LLC. And the same agreement, but in a corporation, is called the bylaws. So after you form your company, articles of organization or articles of incorporation with the state, then you will draft bylaws or an operating agreement that describe how you run the company, and that includes how you vote and how you do governance. And governance is important because you and your partners might disagree with each other down the road, and you have to make sure that you sort of define how voting is going to happen. You know, even more so than marriages, I think relationships and partnerships can go, in corporate partnerships can go south. Unlike in marriage, I think it's probably fine to routinely have something like a prenuptial agreement, which is the bylaws and the operating agreement. It's like, we're probably always going to get along, but just in case, this is how we're going to run things. So it's complicated, and it's a challenging journey to build and run a company. So you should be aware of those worst case scenarios as you're crafting your operating agreement and your bylaws. You know, it's really awkward if there's like two of you and you each have half the company, and I mean, you know, unless you both agree on everything, nothing's ever going to happen. So, and that kind of gets to establishing relative ownership of the company, which is maybe an uncomfortable conversation, but you know, it's better to have that uncomfortable conversation now rather than later. You know, there's probably a logic for one person having more than another person, and you should talk that through. And, you know, honestly, don't do it by email. It's nice to do over a dinner, give you a beer, to sort of talk about, hey, let's talk about how we're going to split the company. Let's talk about what you're doing. Let's talk about what I'm doing. And if you're comfortable, you can sort of, ask them to suggest something, but that's a little dangerous. But just sort of lay out there what you think the relative contribution of each of you is to this venture, and then decide on ownership shares. So don't put this off, don't avoid it. It's something you need to do. Why might somebody be valuable? You're probably all thinking the inventor and the technical person is the main valuable person, and they are super valuable, that's for sure. But maybe you got a CEO that's taken 2 companies to IPO, and they're maybe going to be able to do this again, and certainly that's what investors think. So if you have success with prior companies and exits, maybe you have access to C-level people at companies and partnerships, that's valuable. So, or maybe you're going to kind of go out and pitch and help raise money, and the other person doesn't want to do that. So just kind of list what everybody brings to the table, and then decide how you're going to split based on that. Then when it comes time to talking to the investor, you're going to have to talk through some of this financial stuff. You're going to have to agree on the terms. The simplest term is how much they're going to pay for the shares and how much of the company they're going to own. So all of this and the other terms are going to be typically in like a 1-page document called the term sheet. So at some point you want to bring lawyers into the equation. Don't do that too soon. Lawyers think differently. So technically I'm a lawyer. You negotiate what you think is fair, in a friendly manner, in 1 page, and then you have a lawyer put this into a 20-page document that protects both of you. This is very off-putting to get a 20-page document, and there's like 4 things you care about, and you can't find them in the documents. So, also, I was telling somebody earlier today, the etiquette as you're negotiating term sheets or agreements is to never make a change without the other person knowing it. So please always use track changes if you're using Microsoft Word, and don't accept changes without letting them know. A lot of this is about trust. And if people feel you're trying to slip something in, even though you weren't, you lose trust. So I think trust is really important in negotiations. So you can be tough, but you got to be ethical. So.
Can I just point out one thing that your comment about the number of pages is generally true, but
yeah,
in the last couple of years, due to some of these new instruments, so the safe,
sure,
can be substantially smaller.
Yeah, the safes are really nice. So, and I'll talk about that a little bit at the end. And the nice thing about safes, which we'll talk about in a little bit, is they're the same everywhere, because Y Combinator puts them out. So you don't have to worry that somebody's doing something funky, which is the reason people go with them, which is probably why they created an acronym that is the word safe.
Yeah.
So as you're negotiating with the investor, they're going to say, there are really 3 things, the pre-money, the post-money, and then what fraction of your company they own. Between those 3 variables, if you know 2, you can calculate the 3rd. So what's the pre-money? What's the post-money? The post-money is the pre-money plus their investment. So it's however they value you. If they say you're worth $1 million and you agree that you're worth $1 million, and then they put in $500,000, then they own 1/3 of the company. So it's 500,000 that they put in divided by the post money, which is 1.5. So that's what the investor ownership is. It's the investment that they put into this divided by the post money. So the tricky thing that you are negotiating is one of 2 things, and they're the same thing. Is what % ownership do they get for the money they're going to give you, which is the same thing as saying what's your pre-money. If you know one of those things, you calculate the other. So, and you're probably going to want to argue that your pre-money is a big number, and they're probably going to want to argue that it's a small number. So, and that's all fine. And I'm all for arguing it's a big number, but don't argue that it's bigger than it should be, because what's going to happen is later you won't be able to raise money, or the more savvy investors will say, this was overvalued, now we're bringing you down. So argue for it to be as valuable as possible, but don't be unrealistic either. So this is my example. So if there was a pre-money valuation of 2 million and they put in $1 million investment, 1 divided by 3 is 33% of the company that they would own. Generally, it would be uncommon for you to give up more than half your company in the first like Series A or so. You know, at some point you probably will lose control and you'll have less than half, but hopefully that'll be after a couple rounds or more. So again, why it's important that you have a good relationship with the investor. You know, at some point they're probably going to have control of this, or versus you. So they're trying to size you up too. They want to know that they can trust you. So as you mentioned, the safe notes are a good way to go, and you can avoid the need to value your company with a safe note. So simple agreement for future equity is what SAFE stands for. You can get these, you can download them from the Y Combinator website. And so, you know, you don't necessarily need to hire a lawyer because everybody has the same document. So there's certain terms you need to negotiate in the safe note, but you can just use it off of Y Combinator. And the reason safe notes are kind of nice is the way safe notes work more or less is say you're going to put $200,000 in a company, you're agreeing that we'll decide what that is worth in terms of number of shares after a later round, which is probably a larger round, maybe a Series A or something like that. And the reason that's kind of helpful is, in theory, the later rounds with the venture capitalists, they typically know more about what they're doing and they're able to value it more. You may well argue with the angel and say that they don't know what they're doing. They don't know how valuable I am. Just avoid that whole discussion and get a safe note, and then you'll be valued later. So the other thing is, aside from whether you disagree with them or agree with them, is just, you know, a couple more years down the road, you have a chance to further build your company and establish that it has the value that you think it does. So safe notes are nice. The other term that I think you should know is the cap table or the capitalization table, which is just, doesn't have to be anything fancy. You can do this in Excel. You just list all the shareholders and what fraction of the company they own. So you can have each person's name and then how many shares they have and so on. So for those of you that are connected to universities, I won't name any university, but one person at one of them thought that the university should get 50%. And my reaction was, well, in my head, I was like, you're insane. But what I said was, why don't you research what other universities do? But less than 10%. I mean, you'll negotiate this. If you can get 5%, that's good. So they'll want some equity in your company for them giving you license and intellectual property. Yeah, were you gonna say something? Yeah, that's for the license. You know, you got to look at your employment contracts and see what they own in terms of what you do in your free time. A lot of universities are fine with you doing stuff in your free time, and they're not going to own anything. But if you did stuff at work, most institutions are going to say we own that. But not every institution is like that. Some are like, we own everything you do at home and everywhere. So just make sure you know that before you go off and start your company. So here's just a listing of some, and there's lots of resources on the internet, and I give you some links here. The top 10 overall VC funds. So Sequoia is a famous one that everybody knows. I don't know, it's probably like $1 billion fund. When they fund things, probably $10 million is too small for them because they don't want to fund 200 companies. They want to fund 10, 20, 30 companies. And so they're funding things bigger. So, you know, most of us should not go to Sequoia until we're ready for something that big. Likewise, you shouldn't go to most of the firms in Wisconsin if you need $5 million or $10 million. So, and then on the right here, I have listing the top 20 corporate venture capital firms. So for those of us interested in healthcare, you can see J&J is on here somewhere. I'm trying to see if they're, yeah, number 6, yeah. When I started my company, J&J Investment was the first in, which was nice because as soon as somebody like they are in, then that's like a validation to other investors. Are like, oh, so think about corporate venture as well. Here's a nice list coming from Wisconsin Technology Council. If you're raising money in Wisconsin, of different angel networks and angel and venture networks. So there's a lot to choose from. Again, you should go to their website and see what they focus on, you know, in terms of the areas they fund. You know, I'm interested in pharmaceuticals. So like almost everyone in Wisconsin says, we do not do capital intensive or highly regulated fields. I'm like, well, why don't you just say pharmaceuticals? That's what it is. So there's really, I would say just 2 or 3 that you can go to if you're pharmaceutical. If you're diagnostic and you're looking for maybe $2, $3, $4 million, there's probably more choices. Wisconsin Investment Partners for an angel group is pretty good. So, and others, 4490 and so on. But if you need something really big, that's venture investors. So, deal size, if you're curious, in Wisconsin. So these are the last 3 years. So we do have, I was surprised when I saw this. There are some pretty big ones as well. So these are big ones. But then you quickly get down to the 7 and 6s and so on, which in California you wouldn't get down to the 7 and 6s so quickly. So, but I'm impressed that we got some really big ones here as well. So yeah. And then the links are here as well. This is Wisconsin Tech Council. So, and I would argue, if you need to raise a lot of money, like a few $1 million, you got to get out of your comfort zone and leave Wisconsin. Once you talk to venture investors and 1 or 2 other, then you got to go to California. Or, if you look at where most of the money is spent, $56 billion in California, $13 billion in New York, $10 billion in Boston, versus all of the Midwest, $4 billion, and those tend to be smaller anyway. So you should really kind of broaden your net when you're kind of hunting for money. I would go through the process of building an Excel sheet and then prioritize all the VC firms you want to approach and research them to know which are the ones I should go after first, and then you proactively do it. So, and hold yourself accountable. You're like, this week I was going to contact 4 of them. I contacted 5 last week. I haven't heard back yet. I'm going to send a tickler. So be systematic and process oriented about, your fundraising. And then, yeah, go ahead.
One more comment is, sticking to the Wisconsin discussions that we're talking about, Badger Fund of Funds.
Yeah, so Badger Fund of Funds you brought up is run by Ken Johnson, and it's a state-funded fund of funds that is include a number of funds like Fidanza Fund. Winnow Fund is a new one, and there was I think there's about 5 of them right now, and they're a great resource for fundraising. They're not going to be the 2-3 million, but if you need a couple $100,000, I think Winnow Fund will routinely do $500,000. So yeah, and there's a proposal by Governor Evers to have $100 million going more into this, but then that kind of got derailed, and we're kind of figuring out where to go with that. There is a private fund of funds called NBNG that is raising money now. Trying to remember if what you told me was confidential, so I won't say anything.
I heard about this.
But they're raising money, so we'll have a fund of funds that is parallel to Badger Fund of Funds. That's funded by corporations. So the money situation in Wisconsin is getting better. But you can see in this plot on the right, the average size of, say, a Series A, which is the kind of darker blue, is about 8 million. So that's the average size of a Series A. That's a big number in Wisconsin. So you just have to make sure if you need that kind of money that you're going to the right places. And then finally, I just want to point you in the direction of some really good resources. If you're going to look at what's going on in the venture capital world, what the firms are, what they're funding at, NVCA is the National Venture Capital Association. That's kind of the main place to go for information on venture capital. If you want comps for what other companies are being acquired for, you can go to places like PitchBook or Crunchbase. Cambridge Associates has a lot of statistics on venture capital. If you want to raise venture from, say, healthcare and pharma, the main conference to go to is JP Morgan, which this year is in San Francisco. And it's invitation only, but you don't actually need to go to the conference. This is where all the venture capitalists go. So if you want to kind of meet and pitch to venture capitalists, you can approach them, and then you can say, and I'll be at JP Morgan. So if you want to kind of meet at a coffee shop, I can go over my deck with you. So that's kind of a good strategy as well. So, and that is Venture Capital 101.